There is one way to trade that is infinitely better than the rest. Now, after trading for 6 years, I have tried everything from options to penny stocks, futures, swing trading, scalping, you name it. And there is nothing that is easier or faster than this one simple strategy that nobody else is using. Make sure you stick until the end because I'm going to show you how I personally used this strategy yesterday to make $925 in 30 minutes. Every strategy out there has both pros and cons to it. If you take a look at scalping, for example, one of the biggest pros of scalping is that you're getting in and out very quickly, which means you're going to be making profit a lot quicker, and there isn't a lot of time for emotions or psychology to influence your decision making. Now, one of the big cons of scalping is that you have to sit in front of the screen for hours throughout the day just to find multiple good setups so you can take a bunch of different trades. Now, this is where a disadvantage comes into play in terms of trading swing trading. And the reason why swing trading is so much better in this regard is the fact that you can get in, set your stop, set your target, and walk away for days. And you're basically making money on autopilot if you have a working strategy. Now, a major downside to swing trading is that sometimes it can take weeks or days, even months to even find a good setup. And it takes, again, more weeks or more days just to actually collect your profit. Now, the same thing goes for trading shares or trading futures or the method of you're actually trading. If we take a look at shares, for example, the cons is that it takes a lot of money to actually see a good result. Most stocks only move a few percentage points each day. So if you really want to make $100 a day, you need to have around $10,000 to make a 1% move. A lot of people don't have that amount of money, so it makes it tough to see your account grow pretty quickly. Now, if you're trading futures, for example, there's a lot more leverage. And so that means you can take a small account of a few $100 or a few $1,000 and turn it into $5,000, $10,000, $15,000 relatively quickly because there's a lot of leverage. Now, the downside of futures is that you can only do it on a few different names like ES or NQ. Can't really trade any stocks with it. Now, there's tons of different pros and cons to all of these strategies, and I've tried all of them. But there's one in particular that has a huge disadvantage to it, but if used correctly, can actually turn into a massive advantage. And that is going to be options trading. Now, let me explain how options work. Options are very simple. What you're doing is buying the right to purchase 100 shares of a certain stock at a certain date. Now, that can be a little confusing, but the best way to explain it is you're basically trading bigger name stocks with a lot more leverage. Options are both calls and puts. Now, calls, if you buy a call, you're expecting price to go up. And all of these options have something that's either called in the money or out of the money. And that has to do with the strike price. So the strike price has a bunch of different selections of the actual option that you can buy. So if Apple is sitting at $200 and you want to get an option that is in the money, all the strike prices that you buy are going to be below 200. So it'd be 195, 190, 185, etc. If you want to trade something that's out of the money, you're going to get a price that's higher if you're getting a call. So if Apple is sitting at $200, you're going to be getting the 205, 210, 215, or anything above $200 is going to be an out of the money option. Now, being able to trade these stocks with a huge amount of leverage seems like a really good deal. And that's why options are very popular. But with every advantage comes a big disadvantage. And with options, that's going to be time decay. All of these options have an expiration date on them. So some of them may expire every week, some of them may expire every month, and if you're trading SPX, those options expire every single day. The reason this is so key is because if price is not in the money by expiration, the option is going to be worth zero. So if you own it and it's not in the money, you're going to lose all of your value. This is why trading options is so tough. If price is moving up and you buy a call, price can move up from where you actually bought it, but if it doesn't go in the money by expiration, you can actually still lose money even when you got the direction right. Trading is already hard, but trading options is so much more difficult because you not only have to be right in price and direction, but you also have to be right on timing. But there's actually a way where you can trade options so it's in your advantage of time instead of disadvantage. All stocks have options decay, so over time, price is going to go down. The value of the option is going to decrease over time as we get closer to that expiration. But what you can do is actually sell options. And selling options, you're taking advantage of that time decay. You see, every time you buy an option, there's somebody who's selling it. And if you're selling it, you actually make money when the value of the option goes down. And over time, if the value of the option goes down because of time decay, it makes sense that you'd want to be selling or shorting these options. Now, there's two strategies that work extremely well when it comes to shorting these options. And the first one is going to be called a credit spread. So credit spreads are when you buy a call and you sell a call that's a lower strike price at the same time. Let me show you an example. So if we look at this demand zone here on SPX, this was my thought process coming into the trade. You can see that price came down, we bounced off this demand zone, and so I figured that price was not going to go below this demand because of my strategy. Now, because of that, I knew that I could get a credit spread below my demand zone, and I would be able to make max profit as long as price stayed above my strike prices, or as long as price closed above it. So what I did was I sold the 4565 puts, and I bought the 4560 puts. And that gave me a net credit of $1.52. And because it represents 100 different shares, that means it cost me $152 of credit. Now, I did that times 5, which ended up being around $925 in total premium that I had. And because price just kept going up and up, and it went down and went back up, and we closed all the way above here, I ended up netting the full profit and made $925. The best part is that price could have done anything. As long as price stayed above this demand zone, if we came all the way down towards the bottom of it, if we came just right few there and we closed right around here, I still would have made $925. Doesn't matter if price goes all the way up. Doesn't matter if we close right above it, 4566. I'm still going to make that $925 because I let it expire out of the money. So let's say Apple is trading at a price of $192. What you'd want to do is sell the 190 call and then buy the 185 call at the same expiration. We'll say 3 weeks out, for example. Now, the 190 strike price may be going for $2, and the 185 strike price may be going for $1. So if you're selling the 190 strike and you're buying the 185 strike, you're going to get that difference of $1 in a credit, which means the broker is essentially giving you $1. But since it represents 100 shares, that's actually going to be $100 of credit. Now, the way to make money with this strategy is that all you have to do is tell where price is not going to go. And since we sold the 190 call and we bought the 185 call, we want both of those strikes to end up being expired out of the money. And in order to make our profit, we need price to stay above 190. This comes with a huge advantage because if the price of Apple is currently at 192, but we need it to stay above 190 to make profit, price can still go down and we can still make $100 if both of them expire out of the money. Price can also go way up and we're still going to make that $100 because the option expired out of the money. This makes trading a lot easier because instead of having to be right on both direction and time, you only have to be right on the direction in terms of saying price is not going to go below or above a certain level. So that means you can buy, have price go up, have price go down a little bit, have price stay where it is, and still end up making $100 with this strategy. Now, my favorite way to trade these credit spreads is actually going to be on SPX, taking advantage of those 0 days to expire options. Now, SPX is a little weird, and the fact that every single day there are options that expire that day, which makes it really fun for day trading. SPX is relatively pretty choppy, which actually makes it good for a credit spread because if I get in, price can kind of just stay where it is and I'll end up making the full profit as long as price stays above or below where I get my strikes. For example, if price comes down to a demand zone on the 15-minute chart in SPX, I can get a credit spread, get both of my strikes below that demand zone, and as long as that demand zone holds price and we either rip to the moon or we just stay inside that demand zone or right above it, I'm still going to end up making that max profit. That's how I was able to make $925 trading SPX. Now, this strategy doesn't always have the best risk reward, but it makes up for it because it has such a high win rate. You can get in at 192 and set strike or stop losses all the way down at 185. And even if price goes down, you can still make profit because of options decay. Now, the next strategy to take advantage of options decay is going to be iron condors. Now, iron condors are typically a little bit better to swing trade because it's a lot more fun, it's a lot more relaxed, and you can still make a lot of good money without even really knowing what price is going to do. Now, iron condors in the simplest form are essentially both credit spreads on the put side and on the call side. And you do this on both sides because it's a neutral position. Meaning with an iron condor, you're betting on the fact that price is going to stay within a certain range. So here's an iron condor example on Apple. So Apple, I'm getting this 25 days out. And if we take a look, we can see that we have two different credit spreads on here. We're selling the 180 puts and we're buying the 175 puts. And we're selling the 200 calls and we're buying the 205 calls. And the way the strategy works is that as long as price stays in between 180 and 200 within the next 25 days, or I'm going to make $77 from this contract. Now, you may be thinking, Jordan, that's not a good risk reward. I'm risking $423 just to make $77. And while yes, that is true, if we take a look at Apple, the odds of price going outside of 180 or outside of 200 is relatively low, okay? If we're talking 25 days out, that would be January 5th, which January 5th is right around, pull out my little array here. January 5th is going to be right here. So we're basing the fact that price is going to stay within this zone by this date here, and we're going to make $77. Now, again, the risk reward isn't good, but price can do pretty much anything, and you're going to make good money, right? It can come all the way up here. It can come all the way down here. Price can pretty much do whatever it wants as long as it closes within this range. So price can even come back below it and then come back inside. And as long as we close in between 200 and 180, we're going to make that $77 right here, risking 423. So going back to that example on Apple, if we get an iron condor for, let's say, 200 and then 180, and the current price is at 192, all we need is for price to stay in between $200 and $180 within a certain time frame, and we're going to collect a max profit. Now, you have to be careful trading these because you can lose a lot more than you actually put into the position. So if you're wrong, you could end up losing quite a bit more. So it's always important that you're aware of the risk and your max loss while you're trading. But if you're tired of having big losers and getting chopped up on 0 DTE or weekly expirations, it may be worth a shot testing out selling options. I've traded for so many years, and I can tell you that taking options decay into your advantage and making money from it is going to get you a lot less stress when it comes to trading and also make you a lot more money. Hope you guys enjoyed this video. If you did, please subscribe, leave a comment down below on other videos you want me to make, leave a like, and I'll see you guys in the next video.